This starts podcast B of Chapter 11, Pricing. After a company considers customer issues in setting price, including demand forecasting and sensitivity to changes in price or elasticity, they also have to consider the cost structure of their business. All companies have two types of costs that include fixed costs and variable costs. Fixed costs do not vary with the number of units produced, and for most companies this would include costs of the building, equipment, utilities, salaries, overhead, things that the company has to pay regardless of whether or not they sell any product. In the high-tech arena, these would include investments in servers and bandwidth. Variable costs, on the other hand, do vary with the number of units produced. And so if a company has a manufacturing or a production line, these would include all the raw materials, parts, and components that need to be brought in to manufacture or make the product. For service-oriented companies, variable costs are a little bit harder to manage because oftentimes it's harder to staff up or staff down based on the level of demand. The sum of fixed and variable costs creates the total cost component for a company in terms of estimating their pricing structure and their profitability. Cost is a primary factor in determining a company's break-even point. Break-even points can be computed in different ways, and in class we'll be doing break-even analysis using a very simple equation: profit equals total revenue minus total costs. Essentially, break-even is the point at which a firm doesn't lose any money and doesn't make any profit. It is the point at which it covers all of its costs of doing business. A company can either solve this equation for quantity at a given price, or it can solve this equation for what should the price be given a particular forecast for quantity. Break-even analysis is a simple heuristic that can be used to establish a point at which the company will be profitable. But the break-even analysis is only as good as either the forecast being used or as good as the cost accounting is in the organization. If the costs are misallocated or underestimated, then certainly the decisions made on that break-even analysis will not be useful. In addition, break-even analysis does not consider what competitors are doing or how customers will respond. So it's very important to realize that break-even analysis cannot be used as a standalone pricing tool. In terms of graphing break-even analysis, what we see is that the point at which the total revenue line intersects the total cost line is the break-even point. Now, because most companies are not satisfied with making zero profit, and even non-profits do make profit, it's a question of what they do with the profit they make in terms of reinvesting it into services. Most companies actually establish some sort of an objective for profitability. Oftentimes that objective is a function of the return on investment. So if a company sets an objective of a 10% return on investment, when we solve for the left-hand side of that equation, we don't plug in zero as we do in break-even analysis. What we do is we plug in a desired profit amount, where we multiply the ROI objective times the investment. For example, General Motors invested $1.2 billion in creating the Volt. And then the question becomes, what is their desired ROI on that investment? Another pricing methodology is based on markups. And one issue in doing markups is considering all of the different impacts that each stage of the distribution channel has on those markups. I examine pricing strategies along the channel by drawing a supply chain and identifying clearly the price paid by each channel member and what their desired margins are. There are many different pricing strategies that can be used, and as you see on this list, what we'll be covering in class are just a few of these to give a flavor of how these pricing strategies and tactics work. Target costing is oftentimes called demand backwards pricing. What you see here is that step one starts with the price customers are willing to pay. This price is determined based on market research, oftentimes using a technique called conjoint analysis, where willingness to pay is the variable being developed. That price customers are willing to pay is sometimes called the sweet spot. Then what we do in target costing as a pricing analyst is we work backwards through the channel. And because marketing takes a customer-oriented perspective, these margins are not based on the cost from the upstream member, but they're based on the actual dollars that the retailer earns from the sales of the customer. So we're going to go demand backwards pricing. The reason that this is also called target costing is because what we see in step 5 is that this method allows the manufacturer to identify what is the maximum cost that that company can incur to produce their product and still meet the margins for each channel member and hit the sweet spot. We'll be talking about target costing extensively in class because it is a very controversial technique that essentially justifies why U.S. companies engage in outsourced production to substandard factories in countries like Thailand and China. And the reason that they give is American consumers want cheap goods, and the only way we can do that is by outsourcing for cheap labor to achieve our target cost. There are huge ethical implications with this, and recent tragedies with fires in these factories is resulting in changes. There are different types of pricing strategies. Pricing strategies based on the competition are oftentimes focused on the position that a company wants in the market. So if we have a premium product, our price should be higher than the competition. If we have a value product, our price should be based lower than the competition. And remember, we have to define the competition broadly to include not only direct competitors, but indirect competitors as well. There are a couple different strategies for new product pricing. One is called skimming. The definition of a skimming strategy is when a company charges a high or premium price in the market for its new product. Companies tend to use this when they know that customers value those benefits and are willing to pay for them at any price, such as a new pharmaceutical that has less side effects or solves a previously untreatable condition. Obviously, pharmaceutical companies are highly criticized for using this strategy. In addition, a skimming price is used under monopoly conditions, where there's a little chance that competitors can enter the market quickly. These conditions exist typically when there is patent protection in the market, again in the case of pharmaceuticals, or in the case that a company has a monopoly condition. For example, in the textbook market, oftentimes bookstores do have a monopoly type of situation, although that's changing with on-demand publishing, book rentals, and online booksellers. A third time that we see skimming pricing is when there are different customer segments that value the benefits of the product differently. And in this case, again, in the U.S. market, given the education system, we tend to see a skimming price strategy used for new textbooks. On the other hand, an alternative pricing strategy for new products is called penetration pricing, the definition of which is the new product is introduced at a low price point. Penetration means penetrating the market, gaining high market share by pricing low. Given downward sloping demand curves, the low price encourages demand, and sales ramp up quickly in the early stages of the product life cycle. Furthermore, a low price discourages other competitors from entering the market. It makes that market less attractive. Other types of pricing strategies include price bundles. For instance, it's very common in the digital market today to have what's called the triple play, where cable companies bundle internet, cable, and phone service. There's quite a bit of research on price sensitivity and when bundling makes sense. We also see this in the fast food industry when we have value meals, for example. Another pricing strategy is called captive product pricing. This was introduced by Gillette in the 1800s when they gave away the razors at a very low price or even free, and the company's business or revenue model is based on charging a higher price at a higher margin for the complementary products that essentially give that base product its value. In class, we'll talk about other examples of captive product pricing that you can think of and what the pros and cons of that strategy are. We'll go ahead and finish out this chapter with a couple more slides on terminology in the next podcast.